For the gift tax, we have certain exclusions. The first we're going to talk about is the annual exclusion, and we've mentioned this before, but it's $15,000 in 2018. It usually changes every year. It usually is increased a little bit every year. This is available each year for an unlimited number of donees, and any gifts made under the exclusion amount are not included in adjusted taxable gifts and do not reduce the unified credit. All right, so like we mentioned before, I can give a person property, cash, up to $15,000, and I don't have to worry about gift tax consequences at all. I can give any number of people cash and gifts up to $15,000 each year and not worry about the gift tax liability. We just start worrying about it when our gifts exceed $15,000 for a single individual. There also has to be a present interest requirement to be able to use that annual exclusion. A present interest is an unrestricted right to the immediate use, possession, or enjoyment of property or the income from the property. A future interest is, of course, opposite of that. A future interest is one that limits the use, possession, or enjoyment to some future date. And if I give a present interest, I get to use the annual exclusion. But if I give a future interest, I do not get to use that annual exclusion. So it's all subject to the gift tax. Some helpful exclusions if we want to give money to minors. So if we have children and we're high net worth individuals, we probably want to set up some estate planning for if something happens to us, we can give money to our children. We also probably want to set something up if we are a very high net worth individual that gives our children some access to funds even before we die. The problem with that is that we obviously don't want to give young children access to large sums of money. And we probably want to engage in this estate planning, but we want to reduce our tax liability as much as possible. So we have these two provisions where I can set up a trust for a minor child. The first is the Section 2503C trust, and that's going to allow us to use the annual exclusion for trust to minors, even though they do not distribute all the income annually, if the following conditions are met. So I can give $15,000 every year, or whatever the annual exclusion amount is every year, to a trust for my minor child. And the trustee of that trust does not have to distribute the income of that trust if the following conditions are met. So first, until the beneficiary is 21, the trustee must pay income or the underlying assets to the beneficiary. And any income and underlying assets not paid to the beneficiary will pass to the beneficiary when he or she reaches 21. So here the key age is 21. So I can make these contributions and the beneficiary doesn't have to receive the assets until they're 21. But at the age of 21, the assets have to pass to the beneficiary. So this is somewhat helpful, but maybe I probably do not want my 21-year-old to have access to $10 million. Say I'm a very wealthy person and I want my child to have access to a $10 million trust, but I certainly don't want them to have all of that at 21. Well, then the crummy trust is the next option. The crummy trust is called that because of a court case that basically blessed this trust. It allows us to treat a gift to the trust or a contribution to the trust as a present interest when the crummy language is present. And that language entitles the beneficiary to demand a distribution of the lesser of $4,000 or the amount transferred to the trust each year. So every year, the trustee could demand the lesser of $4,000 or the amount transferred to the trust. But if the if the beneficiary doesn't demand that within a pretty limited time, that provision expires. So each year they have a limited number of days to make that request, and if they don't, it expires. This is going to allow the donor to create a trust that terminates at whatever age the donor deems appropriate. So I could have a trust that maybe terminates at age 35 instead of 21, as long as I have that language present, that language that allows the beneficiary to demand a distribution of the lesser of $4,000 or the amount transferred to the trust. So that's helpful because even if the parents are probably thinking that the child or the beneficiary is not going to make that demand, but even if they do, $4,000 is much less than immediate access to $10 million at age 21. Another deduction is a marital deduction, which allows spouses to generally shift wealth between themselves tax-free. Again, this doesn't matter to us as much in a community property state like Texas, but it matters in a common law state where if we have one working spouse and one non-working spouse, the non-working spouse really has nothing. So the working spouse has to gift those assets to the non-working spouse. Gifts of terminable interest, though, are generally ineligible for a marital deduction. So a terminable interest is an interest that ends or is terminated when some event occurs or fails to occur. It has one of the following characteristics. The donee spouse's interest is going to cease at a set time, and the property is going to pass back to the donor or to a third party who does not pay adequate consideration. Or immediately after making the gift, the donor has the power to name someone else to receive an interest in the property, and the person named may possess the property upon termination of the donee spouse's interest. So these terminal interests are ones that the recipient of the gift doesn't really control all of the assets that they receive. The donor still has a lot of control over those assets. We have these qualified terminable interest property provisions as an exception to the exception. So if these provisions apply, the donor is allowed the marital deduction. It allows the marital deduction for Q-tip. We call it Q-tip transfers. And a Q-tip is property transferred by the donor's spouse in which the donee has a qualifying income interest for life and for which a special election has been made. The qualifying income interest for life happens when the spouse is entitled to all the income from the property annually or more often, and no person has the power to appoint any part of the property to any person other than the donee spouse unless the power cannot be exercised until after the spouse dies. So Q-tip property must be property that the spouse is entitled to all the income from the property every year or more often, and nobody can change that fact until after the spouse dies. There's also a charitable contribution deduction that allows gifts to qualified charitable organizations to not have to be reported on a gift tax return unless the donor otherwise has to file a gift tax return. And sometimes when we give things to charities, we make a split interest transfer, and that's when there is a gift made for both private and public purposes. So I have a house maybe, and I allow someone to live in the house for their lifetime, and then I donate the remainder interest to charity. So after they die, that house and land is going to go to charity. That's a split interest transfer. And if a donor gives a remainder interest to charity, the donor may forfeit the charitable contribution deduction depending on the nature of the gift. So often in that case, I don't get that charitable contribution deduction, and that transfer, that split interest transfer, is subject to the gift tax. We also have the gift splitting election, which we've already touched on. It allows gifts made by one spouse to be treated as made one half by each spouse. Spouses must meet the following requirements to take advantage of this. They must be U.S. citizens or residents, and at the time of the gift, the donor spouse must be married to the person who consents to the gift splitting, and they cannot remarry before the end of the year. The election is effective for all gifts made to third parties during the portion of the year the spouses were married. So if this election is made, it applies to all the gifts made that year. I can't elect just piece by piece, and it applies so long as the spouses were married. So it applies for the months of the year that they were married. Bonnie, a widow, irrevocably transfers $1 million of property to a trust and names a bank as trustee. For as long as Bonnie's daughter Carol is alive, Carol is to receive all the trust income annually. Upon Carol's death, the property is to be distributed to Carol's children. Carol is 32 and she currently has 3 children. How many gift tax exclusions does Bonnie receive for the transfer? All right, well, what we have here is one present interest transfer to Carol, and then we have future interest transfers to Carol's children. So when we are talking about gift tax exclusions, remember I can take a gift tax exclusion for a present interest transfer, but not a future interest transfer. So here Bonnie's going to receive one exclusion. Only Carol receives a present interest, and her children receive future interest. So those 3 children that receive a future interest, I don't get to take an exclusion on those children. I only receive one exclusion. In the current year, Kent gives $42,000 cash to each of his 8 grandchildren. His wife makes no gifts during the current year. A. What are Kent's taxable gifts, assuming Kent and his wife do not elect gift splitting? If they don't elect gift splitting, remember this is treated as only coming from Kent. So Kent gets to take a $15,000 annual exclusion for each person each year. So he made gifts to his 8 grandchildren. So for each grandchild, he gave $42,000, and he gets to exclude $15,000 of that. So he did that 8 times. He has $216,000 of taxable gifts. Part B, how would your answer to Part A change if the couple elects gift splitting? Well, if the couple elects gift splitting, we act as though Kent gave $21,000 cash to each of his 8 grandchildren, and his wife gave $21,000 cash to each of his 8 grandchildren, and each of them get a $15,000 annual exclusion for each person. All right, so here, each spouse is deemed to have given each grandchild $21,000, and the taxable gifts are $48,000 for each spouse. So they gave $21,000, they got to exclude $15,000 of that. They did that 8 times. So each spouse made $48,000 of taxable gifts. When I add those together, they made $96,000 total taxable gifts. So you can see it's a big savings if we elect gift splitting. Hugh makes the gifts listed below to Winnie, his wife, age 37. What's the amount of the marital deduction, if any, attributable to each? A. Hugh transfers $500,000 to a trust with a bank named as trustee. All the income must be paid to Winnie monthly for life. At Winnie's death, the property passes to Hugh's sisters or their estates. All right, so, and they're asking, what is the amount of the marital deduction? So in Part A, the Q-tip rules do apply. This is a Q-tip transfer. So Hugh receives a $485,000 marital deduction, which is calculated as the amount he transfers minus the annual exclusion. It's limited. So again, this is a Q-tip transfer because Winnie gets the income for life, and no one can change that during her life. B. Hugh transfers $300,000 to a trust with a bank named as trustee. Income is payable at the trustee's discretion to Winnie annually until the earlier of her death or her remarriage. When payments cease, the trustee must distribute the property to Hugh's children by a previous marriage or to their estates. All right, so this one is not a Q-tip transfer, so there's no marital deduction. It's not a Q-tip transfer because Winnie's not entitled to all income for her life. Her interest will cease if she remarries. And the trustee can exercise discretion in paying out income. So notice it said that the trustee may pay Winnie the income annually, not must pay the income annually. So this receives no annual exclusion because the income distribution is discretionary. Tien, age 70, transfers a remainder interest in a vacation cabin to a charitable organization and retains a life estate in the cabin for herself. A. What's the amount of the gift tax charitable contribution deduction, if any, attributable to the transfer, assuming the 4% applicable interest rate? All right, so you can see we calculated this based on the tables, the actuarial tables, and they calculated it based on her age and the discount rate to be $59,764. That's the value of the gift, the amount of the gift. I'm not allowed an annual exclusion because this is a gift of a remainder interest. The vacation cabin is a personal residence, so I don't get that charitable exclusion. B, how will your answer change if she instead gives a remainder interest in a valuable oil painting to the organization? Again, no charitable contribution deduction is available now because this is a split interest transfer and the remainder is not in a personal residence, farm, or ranch. Okay, so now we have gone through all the rules. Now we can actually compute gift tax liability. This is the process, and we need to remember this is cumulative, so this is different than income tax. All previous taxable gifts made during the donor's life, plus the donor's taxable gifts for the current year, affect the marginal tax rate for the current taxable gifts. So this is the process. First, I determine gift tax liability at current rates on the donor's cumulative taxable gifts. So this is kind of weird. It feels kind of weird. So we add up all the cumulative taxable gifts over the donor's lifetime. So not in 2018, the whole life. So we add them up. And then we determine the gift tax liability on that sum of taxable gifts using the current taxable gift rates. And those rates, if you have a hard copy of your book, are found in the very back cover. If not, they're just in the rate schedules. But what we're looking at here is the unified transfer tax rates. And you can see that the rates go up as the amount of cumulative gifts go up. So step one is determine the gift tax liability at current rates on cumulative taxable gifts. Step two is to determine the gift tax liability at current rates on the cumulative taxable gifts made through the end of the preceding period. So if we were talking about the tax year 2018, step one would be to add up all gifts made from birth through the end of 2018, and we would determine the gift tax liability at the current taxable rates. Step two would be add up the cumulative gifts from birth to the end of 2017 and calculate the gift tax liability at current rates. Step three is going to be to subtract the gift tax determined in step two from that in step one to determine the gross gift tax on current period's taxable gifts. So even though this is a cumulative calculation, I have to pay it every year, or I have to compute it every year. So if I've computed and paid every year, I don't have to repay it. I just take into account my cumulative gifts in calculating what I need to pay this year. And remember, we have that unified credit. This is where that comes into play. So it's currently $4,417,800. And the credit for the current year is going to be reduced by the aggregate amount allowable as a credit in all preceding years. So if in 2018 I owe gift tax, I will first reduce this credit by the gift tax I owe. And that credit, if 2018 is the first year I owe gift tax, my credit will be $4,417,800. But if I have owed gift tax in the past, I will have reduced that credit. So once that credit is used up, then I have to actually start paying in gift tax. But I don't have to pay it until I use up all the credit. Okay, problem 50. In 2018, Homer and his wife Wilma, who are residents of a non-community property state, make the gifts listed below. Homer's previous taxable gifts consist of $100,000 made in 1975 and $1.4 million made in 1996. Wilma's made no previous taxable gifts. Okay, so Wilma made gifts to Art and to Bart, and Homer made gifts to Linda, a charitable organization, and Norma. A, what are the gift tax liabilities of Homer and Wilma for 2018 if they elect gift splitting and everyone except Norma receives a present interest? Okay, so remember, gift splitting means we treat these gifts as if I made half and you made half, right? So Homer made half and Wilma made half of all of these. So part A, we're going to compute Wilma's tax liability and Homer's tax liability separately. And it tells you at the top they don't have to pay any tax with gift splitting. But we'll first start with Wilma. So Wilma made a gift to Art and a gift to Bart. Remember, it told us that. Wilma made total gifts of $406,000. We elect gift splitting. So we reduce that by half because we would treat half of those gifts as made by Homer. Wilma also is treated as making half the gifts Homer made. So we need to look at that. Homer made a gift to Linda, to a charitable organization, and to Norma. So when I add those up, that's $900,000. All right, so we are down plus 1/2 of Homer's gifts made to third parties, deemed made by Wilma. So half of that is $450,000. All right, and then we need to look at exclusions. We know that we get a $15,000 annual exclusion per person each year. So Wilma gets one for every person to whom she made a gift. Homer gets one to every person to whom he made a gift, up to the amount of $15,000 or the gift, whichever. $15,000 is our top amount, but if we didn't use that up, we don't get to reallocate that to someone else. So and where that comes into play is the gift to Bart. We only gave $6,000 to Bart. So I can't take everyone who received a gift and multiply it by $15,000 because that wouldn't be right. So for Bart, the total gift was $6,000. Wilma gets to deduct, is treated as making $3,000 of that gift, so she gets a $3,000 exclusion for that particular gift. And then for Art, Linda, and the charitable organization, she gets $15,000. So that's how we ended up with $48,000. It was 3 recipients times $15,000 plus $3,000. She also gets an exclusion for the charitable contribution deduction, that $50,000 that we donated to a charity. She gets to take an exclusion for the $50,000 minus her annual exclusion. So remember the total, it was a gift made by Homer. It was $100,000. We treat it as half made by Wilma and half made by Homer. They each get to exclude that as a charitable deduction. So her taxable gifts are $570,000. And then tax on $570,000 using the tax table. So that's how they got this number. So we went to the unified transfer tax tables and we used them just like we would when we calculated tax on an individual. Her taxable gifts are $570,000. The tax on that is $181,700. And she has a remaining unified credit of $4,417,800. So her taxes payable are nothing. But we reduce her unified credit by $181,700. Okay, now let's look at Homer. Remember, these are the gifts Homer made. He made a gift to Linda, to a charitable organization, and to Norma. It also tells us he has made previous gifts, so we also need to consider that. All right, so we operate this the same way as we did before. Homer made these gifts, $900,000 of gifts. We treat half of that as made by Wilma. So we subtract $450,000, and then we add back half of Wilma's gifts, the $203,000. We subtract the exclusions, that's the same as above. And we subtract the charitable contribution deduction, same as above, to end up with taxable gifts of $570,000. So everything is the same from here, but now is where it's going to differ and where you're going to see the cumulative nature of gifts. So instead of calculating the tax on just $570,000, we have to calculate the tax on $2,070,000. That's the prior gifts that Homer made plus the current year gifts. That was step one, remember. And so now, since the tax is on a higher amount, our top tax rate is higher. This is going to push us, this is a progressive nature of rates, it's going to push us into a higher tax bracket. So the total tax on Homer's cumulative gifts at today's rates is $773,800. But he has probably either paid tax or reduced his credit before for gifts, right? So what we need to do is we need to now subtract the tax at current rates on all the gifts he made before January 1 of this year, which for Homer was $1.5 million. So the tax at current rates on $1.5 million is $545,800, leaving us with a tax on the $570 this year of $228,000. Again, that's more than Wilma paid, and that makes sense because as we make more gifts over our life, the rate goes up. It's a progressive rate. We have a remaining credit for Homer of $4,225,000. Again, that is lower than Wilma's because he used $192,800 of it in 1996. So Homer is not going to pay any cash over to the government this year, but Homer's going to reduce his credit again. So his credit is now even lower. Okay, Part B, how would the gift tax liabilities for each spouse in Part A change if they do not elect gift splitting? All right, so looking at B, we're not splitting gifts now. So we're just looking at the gifts that we made. So Wilma made a gift to Art of $400,000 and a gift to Bart of $600,000. Wilma gets an exclusion of $15,000 for the gift to Art and an exclusion of $6,000 for the gift to Bart, which excludes the whole thing. So the taxable gifts are $385,000, and then I go to my tax tables to compute the tax for that, and I reduce the unified credit by that amount. All right, for Homer, same thing. We add up all the gifts. They're $900,000. He gets 2 exclusions for the gift to Linda and the gift to Norma of $15,000 each. He also gets the charitable contribution deduction of the amount of the charitable contribution minus the annual exclusion. So it's $85,000. His taxable gifts are $785,000. And then remember, we still have to compute the tax in a little bit different way for Homer because he's made previous taxable gifts. So now we take the tax on $2,285,000, which is the cumulative gifts made, and we calculate the tax at today's current taxable rates to get $859,800. We subtract the cumulative tax from birth to January or December 31, 2017. So the gifts he made between that period are $1.5 million. So that is $545,800 to get the tax on the $785,000 at $314,000. And again, we reduce the credit by that $314,000. All right, and in problem 51, in 2018, Henry and his wife Wendy made the gift shown below. All gifts are of present interest. What's Wendy's gift tax payable for 2018 if the couple elects gift splitting and Wendy's previous taxable gifts total $1 million? All right, so again, we have Wendy and Henry. They're going to gift split. Wendy has made 3 gifts, one of which is to Henry, and Henry has made 1 gift to Janet. All right, so first we add up Wendy's gifts. Total gift to Janet, Cindy, Henry of $200,000. Then we subtract half of those gifts because they're treated as made by Henry, gift splitting. All right, and we subtract that, except we do not include the gift to her spouse in that gift splitting. So we don't treat Henry as though he made half the gift to himself. So that's $75,000. We add back half the gifts that Henry made. So remember, Henry made a $30,000 gift to Janet. So I add that $15,000 in. Then I get to subtract the exclusions. So I have 3 of those to Janet, Cindy, and Henry. And I also get to subtract the marital deduction, which is $35,000. So my taxable gifts are $60,000. And again, I need to look at the tax first on all the gifts from birth to today. And all those gifts are $1,060,000. So that's $369,800. From there, I'm going to subtract all the gifts from birth through December 31 of the previous year, which is $1 million. The tax on that at today's rates is $345,800. To get the tax on the $60,000 gift I made this year of $24,000. And I have my remaining credit here. It started at $4,417,800. I have already used up $192,895. That leaves me with $4,225,800. From that, I will subtract the $24,000.